Okay, good evening, everyone. Welcome to another Wednesday night Sequoia Solution Enterprise Training. Now, in terms of commercial funding, we have done a lot of DSCR type of loans, apartment buildings, uh, developments, constructions, and also we've done a lot of SBA loan, working capital, so on and so forth. But there it's a niche. Um, there's one area in commercial lending, it's actually very difficult to find lenders for. Um, this is development. Now, when we talk about development, development is different than construction. So when you see construction, before you can build anything, you have to make sure that the piece of ground is ready to build. They need to be entitled. They need the utility, sewage, everything need to be in place before the vertical construction can be built. Now, many times, a lot of the developers, they will use their own money or they use their investors' funds to develop that piece of land. That's what we call the horizontal development. And once that is done, they will turn around and sell it to the builder. The builder will purchase that piece of land and ready to go. But however, the development side of it, it's actually very difficult to find funding. It's always hard. So, however, we do find somebody that is specialized in this area. We spent a lot of time talking about it, and again, this is music to my ear when he told me that this is exactly what they do, and quite frankly, they are doing some big projects out there. So, without further ado, I would like to introduce our newest partner, Mr. Tom, onto the platform tonight, and he is going to be sharing with us what development it's all about, what their company can do. He is from, wait, hold on seconds. He is from Walden National Mortgage Capital. So they specialize in development and construction all across the country. Not only that they do just funding, but they also partner. They also do JV, and that opens up a lot of door for us. So again, without further ado, Tom, please, the floor is yours. Take as much time as possible to share with us what you can do for us.
Perfect. Thanks so much, Alan, and thanks everybody for getting on the call and trying to learn a little bit about the murky and often confusing world of development, land development. So, just first and foremost, I'm here to answer questions. If you have follow-up, you can reach out and ask because until you learn about it, you think it's this other world that's for other people. If you're not in it or haven't been in it for 30 years, you can't get involved in it. You can't get referred deals. You can't find deals. So I just want to dispel that myth is that anybody out there, if you put in the work or go through your Rolodex, your connections, you will probably find someone that you know that's connected to or will come across land development construction deals. So that's the first myth is that I have to be a builder for 30 years, 20 years, work for a builder to find those transactions. You don't. So I'll go through just a couple rudimentary basic scenarios to how do people even get started in it? How do you find it? So how many of you have ever seen these signs where it says 20 acres, 50 plus acres for sale? It's on some kind of, plywood board, zoned A, B, C, D for this many. So you see those. So that is when somebody has gotten a parcel of land under contract. Okay, so here's step one. If I was younger, I probably would do this, but what people do is they go around, they find out where are parcels of land uh, that are residentially zoned available, and they will reach out to owners and they'll say, "Hey, Alan, you've got this 20-acre, 50-acre parcel out there. It's probably worth $1 million. I'll buy it from you for $2 million, and I'm going to write a 12-month or an 18-month, and I'm going to give you a $50,000. Maybe it's non-refundable." And Alan gets all excited and he thinks, "Oh my gosh, my family land, I'm going to sell it for $2 million or $3 million. I thought I was going to get $1 million." What I do as the developer is I say, "Okay, now me and my partner, we need to go get entitlements." So that's a fancy way of saying, "Can I build 20, 30, 50 homes on Alan's family land, make $10 million or not?" So I go and I need money to get entitlements. And I have to pay for studies. I have to pay for environmental impact studies. I have to find out what do I have to do? Who do I have to pay? What do I need to get done so that I can turn this $1 million, property that I'm going to pay Alan $2 million for into, as Alan said, maybe a property that I sell off to DR Horton, Lennar Homes, Ryan Homes for 5, 6, $10 million. So the land is now entitled, and Alan makes $2 million. I sell it to D.R. Horton as the developer for $10 million, and I just made $8 million minus whatever I paid for the entitlements. It sounds easy. It is that easy, but it's not that easy necessarily to find. But so here's where the challenge comes in: getting the entitlements. So a lot of people that do this, let's say anyone on this call, you might find that property, you might find that parcel, but you might not find it easy to find $500,000 or $1 million that you need to go through the entitlement process, all the things that need to get done to get that ready to sell to a developer. So that's where we come in. So we will work with developers on the pre-entitlement process. So you've got this land locked up under contract for 12, 18 months, and you've put $500,000 into it, but you find out, and we see this on small, couple few million to 10, $20 million scales, where now you find out you've got this land under contract. Alan has a contract with you. You're going to pay him $2 million in 6 months. You're $500,000 in. This was your huge make or break payday. You funneled all your resources and you're short $500,000. You don't have a rich uncle or aunt that's going to say, "Can I just get $500,000? It's going to be worth 3 million, 10 million." No. So that's where land development firms such as ourselves will go in and say, "Okay, maybe this is one of those. Listen, we're not going to give you the $500,000, but we might joint venture with you and we might sell it to a developer and we'll go in it together." Or we might say, "Okay, we'll give you the other 500,000 and now we can get it to the development process." A lot of times the developer may already have a contract with me to buy Allen's land, but they say, "We're only going to buy it if it's entitled." So you have a lot of these, hopeful multi-million dollar developers that are kind of in the middle of, I've got Allen's land locked up. I've got D.R. Horton that's going to buy it for $8 to $10 million, but I'm short, whether it's 500,000 or 2 million in that process. So I just want to pause because I've dumped a lot of information, might be new, might be familiar, just on the little bit how people get pieces of land locked up and where they run into gap funding for that entitlement process to then get it ready to go to developer, because that's one part of our funding process. So any questions? I just want to stop there before I kind of move through about that stage when I give you this information.
Tom, if you don't mind, I think a lot of people in this room are not very familiarized with what land development is, what entitlement is.
Sure.
And can you kind of explain to us, what has
Yeah.
to go through? Yeah.
So, okay. So let's say you find this piece of land, it's 50 acres, and Alan or anybody is selling it, and it says $1 million, 50 acres. Well, if I buy that piece of land and right now it's zoned to build one house on it, because that's the current zoning rules. Just like if you own a home, your lot that your house sits on is zoned R something, which means it's residential and you can build one house on it. So I might have one house on 50 acres and I can only build one house. But if I go to the county and I say, "Hey, county, I want to subdivide, I want to put 20 little squares on this 50-acre lot I own. Can I do that?" Well, that is one of the first steps in the process of entitlements. You say, "I'm entitled to that." It says, "I am entitled to build multiple houses on this." To, to get the approval to do that costs money and it takes time. There are environmental studies. So, oh, you have one house on it, you want to put 49 more. Is there an environmental impact? If you put 49 houses, what does the Department of the Environment locally say about that? Is that something that can be done? Yes, it can be done, but you might need to put in retention pond, stormwater management, and that's going to cost $200,000. So all of these hurdles to, can I build multiple housing units on this piece of land? All the hoops that you have to jump through, scenarios. Those are called entitlements, meaning I'm entitled to build what I want, and I've crossed all these hurdles, whether it's environmental, tax basis, all these kind of things must be approved or signed off by county or other authorities that are local government authorities, so that I can now build 50 homes on this, you know, 30, 50 acre parcel. So you can't just, well, you could, but if I just said, "Hey, Alan, here's $1 million, I've got this 50-acre parcel, and I go, oh, I've struck it rich. And I go down to the county and I say, hey, I want to build 50 houses on this, 50-acre, 100-acre parcel I just bought for $1 million. And they go, you can't. Yeah. Well, now I have basically a farm with a house on it. It's 100 acres for $1 million. So that's the kind of boom and bust where you don't want to put out $1 million or $5 million to buy that lot if you can't build on it. So the entitlement process is a fancy way of saying it's when you find out, can you build all these homes or can you build all that project on that piece of land that you want to buy and make millions of dollars off. In the That's the process that tells you, can you do.
I see. So in there's another myth right there that entitlement is not the same as permit, correct?
Correct. So there's pre-entitlement and there's post-entitlement. So they say, okay, your entitlements say, they're good for 12 months, 24 months. You are entitled to build all these things. It's subdivided, you can do it. So after that part of the process, pre-entitlements, I'm allowed to do these things. Now I need to get permits. I need to go through a different environmental process. Okay, I want to get a permit to put this in. Utilities. Okay, I need to bring in water, sewer, electric. So that is a permitting process. So once you're able to do it, now you have to get permits from different local municipal authorities to actually say, okay, this, that in to build your neighborhood or to build your commercial strip center, your mixed use facilities. So there's pre-entitlement, there's post-entitlement. All right, so we can come in during either of those processes if the numbers work.
Okay.
That's something that's hard to find because there are not a lot of lenders out there that want to come in before the entitlements are given, because that's a risk, obviously. Because
Right.
if we put out millions of dollars and you can't ever build it, or you're not going to get the permits to do these things, that's how there's problems in deals. Any
Totally
questions
understand.
about that?
Yep.
Does
If you have
anyone
any,
go ahead.
yeah, if you, any questions, if you don't want to speak up, feel free to type into the chat box and we can answer for you. Okay.
So
Well, thanks
I'll
a lot,
give an
Tom. Go
example.
ahead.
Go ahead. If you
No,
want,
no,
I
no,
can
go
give
ahead.
an
Yep.
sure. So I'm going to give an example of a real world transaction we had back in May. Um, it was out in Wyoming. So we had someone come to us and they say, we need a $3 million bridge loan. Okay. So they had a $3 million loan on a property that had been appraised. I think it was the end of last year, meaning the entitlements were done. They had entitlements and they were going to build, I don't know whether there's 50 or 75 homes. And the property, as it was, all entitlements, some of the site work was done, was valued at $13 million. So, we got this and our eyes get big thinking, oh, Jade, we're going to partner with them. They just need $3 million on a $13 million as is value site. They're going to build all these homes. Well, what we found out, we do a little more digging, and this is an example of, okay, this is where a problem can occur when it looks like the deal's great. So that was a bridge loan that they wanted on a $3 million bridge. They had already gotten, this would have been their second bridge loan because they were having problems qualifying to get $20 million worth of funding to build all of the homes. Okay. So think about this. You've got this property. This land has been developed. You have your entitlements and you need $20 million to construct it. Okay. So they were looking for $20 million and we found that out. And they wanted $3 million so that we could pay off their bridge loan. So the bridge loan lenders think you're going to default. No one's going to give you the $3 million because they know you can't get $20 million to construct this. So it's a wild world with the land development. So, and then you think to yourself, oh, well, couldn't, it's easy to find $20 million worth of construction if all of the homes, when they're done, there's a net profit of about 15 to $20 million. But it's a little bit different when you want to borrow $1 million versus $20 million. The net worth requirements are massive. So this individual, we ended up not doing it. They ended up getting an extension from the existing bridge lender, but there's millions to be made there, but we weren't going to touch it because we knew that that individual would never get the financing to get the $20 million to build out there, out in Wyoming. So that would have been a bad deal for us because, again, although we would have put up 3 million if they, and they had to get, I think it was to the end of the year to be able to get the construction financing because the entitlements were going to run out. So there was a time on it. So you don't get entitlements for 100 years. It's one of those, okay, now you got to build within a certain time. So there are real world scenarios that you think, oh, this is a no brainer. Somebody might come to you and you say, Tom, I only need 50% LTV. Why can't you do the deal? This is a no brainer. It's like a fix and flip at 50 LTV. You probably have lenders all day long that'll just salivate, jump all over that deal. Everybody will take that. But that's not always the case with the land and construction development because there's always additional phases that can stop the project short. Like we're talking about environmental study where you're developing it. The environmental study says you can't. Well, now you don't get permits. Now it's just a $3 million loan on dirt. So I don't mean to say that to say, oh, everything is difficult, but it's not just, oh, it's a low LTV. This should be a done deal. There are additional parts that go into it. So I will say this if you're looking at the slide. So a JV partnership, in this case, we could have gone in with them to be able to say, we'll bring in investors that will have the financial strength so that the $20 million construction loan can be obtained. Okay, so if you have the deal of the bridge partner, you say, Tom, I have this person that needs $3 million. They're going to build $20 million construction costs. And when it's done, it's going to be worth $50 million worth of homes. This is an easy deal, but your client doesn't have the financial strength and the PFS to generate a $20 million construction escrow. We can bring in investors, different private equity firms or different family offices that will go in and create basically a balance sheet to have the assets to be able to get that loan. So I don't want to say it's like the old days that, if you're doing loans, in the early 2000s, where if it makes sense, we'll do it. But really, that's how we look at deals like this. If they make sense, we'll do it. Loan amounts, when I say prefer 5 million or up, it's not that we won't do it. So if you have a great deal and it's a million, 2, 3 million, it's not that we won't do it. It's just, as I've just said, these aren't just turnkey type of projects. A lot of work goes into them. And we find that even if it's a $20 million type of transaction, there can be something in the middle where the sponsor, borrower is not, completely transparent because they think, well, if I can just move this and move this money over here and say, oh, I did put on my own capital. Well, it wasn't my own capital. I took the money out from something else. Is the transaction, the deal can blow up halfway through. So a lot of work goes into a $2 million loan, just like a $20 million loan. So we prefer the larger loan amounts just again because a lot of work goes into this, whether it's a million or 10 or 20. So
Perfect.
any questions, I'll stop and ask. Does anyone have any questions?
Well, let me continue asking questions
Wait,
then, since I don't see any questions right here. So,
I have a question.
who's this?
Raymond.
Hey, Raymond, go ahead.
Yeah. Do you also cover California?
Yes, we do. I will give you the disclaimer because we see deals from California as the last one that we had a couple weeks back. They wanted to close in 10 days. That is just something we can't do just because of lawyers and things of that nature. Typically, for California deals, we're going to need about 30 days to close a deal. That's the fastest. So yes, we do, but that's not something we're going to turn around in 2 weeks like other states.
And also just limited to a residential development or open to mixed use like shopping mall, nursing school, or hotel?
Yes.
That
So
kind of project.
we do have experience with hotel financing, mixed use, commercial projects. Yes.
So both residential and commercial development.
Correct.
Thank you.
Okay, so let me ask you this then, Tom. As a lender, obviously you need to assess the risk. So share with us what are you looking for? I totally understand, you're not just looking at LTV, so on and so forth, but I would imagine that you will also look into not only the the PFS, but you also look into their experience, the exit strategies, the things like this, right? So share with us, what you're looking for.
Yeah, so I'll go backwards. The exit strategy. So we don't ever want to get our assets and capital tied up in something that looks like a great deal that has no way to get out.
Right.
So we're always going to see if this is something, we're going to put $5-6 million into. Like we funded a deal, I think it was back in August, where effectively we required the sponsor to put. So he had a PFS with $3 million liquid. We said, okay, we're going to make you move the $3 million into an escrow account, and we funded $6 million worth of renovations. But that was effectively you had to put that money in because we weren't going to say, oh, we're going to fund the $6 million in renovations for the apartment complex, and then we're in it for 6 and it really needs 9 or 10, and you say, well, I'm not putting that in. I'm not putting in my 3 million. So we will try to effectively hedge any risk by requiring the sponsor to put money into the transaction. This was a 65 LTV. So he had to put the $3 million in to get it to go 65 LTV. So we will require a lot of sponsors that have a lot of these deals that say, oh, this is such a great deal, to put in the money. So it's not like a fix and flip where you say, oh, if I can get it for 200, put in 200, it's worth $1 million. So if you do 60 LTV, I shouldn't have to put in anything. That's not the math. That's not the way that we do the math on the construction or the land or commercial development deals. They are going to make the sponsor put in funds into the transaction, and having an exit strategy is paramount in this type of world. And if you just, you can do your own research about what do most, whether it's, hedge funds, BlackRock, groups like this, anybody that's touching this kind of space, that's buying or, repurposing commercial properties, usually the 60 to 65 number is where they want to stay at, because we're trying to hedge the risk of if the market moves and we're at 70, all of a sudden we can be at 80 to 90, just like that. So that's typically where you're going to see the LTVs for these type of projects. If it is a true mixed use type development ground up.
Got it. What type of, I see Elvis. Elvis, please unmute yourself, Elvis.
Hey, how's it going there? My question is a more kind of unique, you know, uh, modern concept. A lot of my team members, we work in the sustainable renewable energy space. We're currently right now in northern Michigan. We're starting eco villages. Michigan is actually pretty known for that. We just bought a land out in the city called Mancelona as well, and we're building cooperative of quad unit, co-sharing housing and things like that, communal living. Is that something that's too far, probably stretched for what you're doing, or are you all interested in that kind of thing, or exploring it? I mean, or just the renewable space in general has this space caught up to that, or yeah, it's just kind of questions or flags all over the place.
I'm not going to say, I will say that's not a space that we're operating in. I think that's a new venture. But things like that, I'm not going to say solar, but it's like 25 years ago, people were like everything's solar, it goes so great. Is that there isn't a market to move that type of stuff, or someone to come in and fund those things. If somebody puts in a bunch of money to, no pun intended, to grow that market and to be able to, buy and sell the securities against those kinds of things. There's not a secondary market to do that at the current time.
Well, along that line, there's a lot of tiny home, new way of building houses.
Yep.
What is your thought on something like this?
So I'm just gonna bounce back off of that one time. So for me, it would be my job to resolve that secondary, maybe try to get. It's called secondary what?
So I'll give an example. So in the residential world, the
Hmm.
secondary market is
Okay.
Fannie Mae and Freddie Mac. So, mortgage companies close all these loans under a certain dollar amount, and they don't fund them like a bank does on their books, and they'll sell them off. And there's a secondary market after they close the loan. where they will buy those mortgages, it's 5, 6, 7.5%. So that mortgage can be sold and sold and sold. So with this type of lending, there isn't a group of investors out there that say, we'll buy it, we'll buy it at 8%, we'll buy it at 10%, where you can say, hey, I've got this, $10 million, $5 million note on this sustainable community. It's 9 to 10%. Who wants it? And everyone's raising their hand saying, I want it, I want it. There's a lot of, wait a minute, what can go wrong? What's my return on investment? What are the specifics? Are there, how can I take over the property? Just like how can I foreclose on a commercial note? Very easy, not so much on a residential note. So that's the complexity of something like that, is it's new. It's kind of like tokenization of assets, if you know anything about that. Can you do that?
Yes, I get it. Okay.
I think there's a market for it. It's just, to comment on that, the current administration, just being apolitical, is they've been very outspoken about trying to free up and cut a lot of the red tape with building. You look at the news, and this is why, we're bold and bullish on this, is that them talking about releasing a lot of federal land to build on, to do multifamily, mixed use, because there's a massive housing shortage in the country. Everyone knows that no matter what your political affiliation is, people want more houses. There's just not enough building. Yep. It doesn't mean everywhere. I mean, there's some overbuilt places, but that's a problem for housing affordability. And then the current administration is bullish on trying to cut red tape to do that. So there should be more of those projects available and more individuals doing what we're saying and coming after this kind of financing to build those type of mixed use or just in general residential housing projects.
Sounds good. Yeah, Alan, I want to hear the answer to your question as well. The tiny homes, definitely. So, let's move along.
Yeah. The tiny house concept, I think I like it. I wish I could move into one. That's not gonna happen. But again, the secondary market, Fannie Mae and Freddie Mac, does not have a mortgage for that because it's not, it's not on a foundation. It's effectively it's a mobile home. There are mobile home lenders out there that will lend on mobile homes. So that's the next place that you can go. We talk to different private investors, hedge funds that talk about saying like, hey, would you want to put up $50 million, and create a fund for a tiny house? And then, the joke is like, sure, but the rate's not going to be tiny. You're talking like a 10% rate. So who wants to get, a tiny house and then have a 10 to 12% rate? Right now that's not really cost effective, but if somebody wants to go out there, effectively, it's like you're lending on a mobile home or a camper because it's the same type of thing. You can, a lot of them, they're on wheels. You can take them and move them. Although it's a house, that is what it is. It's not residential real estate. So there's not an appetite for that as far as a secondary market for funding.
I would think it's along the line with ADUs and that type of construction. Am I right?
Yeah. Although Fannie Mae and Freddie Mac over the last probably, I don't know, maybe 4, 5 years has changed their guidelines from a residential perspective on ADUs because a lot of multi-generational individuals will say, okay, I want my family, parents to live on my property, but they've got to put up $250,000-$300,000 in cash to do that. So Fannie Mae has trying to change their guidelines on, okay, how are we going to appraise properties with ADUs, being less restrictive on lending guidelines on properties with ADUs. There's a handful of companies that do offer construction financing on ADUs, and then you can refinance now with a conventional mortgage, taking into account, the $350,000 ADU that you just built. So that's probably, that's like, turning an oil tanker. Is they're starting to say, okay, this is a new age where, the older families aren't just moving away, they're living with kids, different groups of individuals, backgrounds. Some people would think, oh, I have no problem living with my parents. Some people never want to live with their parents on the same property. But there's a lot of groups in America that say like, no, it's culturally, the parents live with the children. So they say, okay, I don't want you in my house. Let's build an ADU. So that has gained a lot of traction, and there are sources for financing for that, but not in the non-residential space with a tiny house yet.
Right.
And that's just based on risk.
Yep. Elvis, your hand's still up. Do you have another question? If not, then yeah, Elvis.
Hey, Tom.
Yes,
So I understand you take approximately 30 days to close a deal from beginning to end.
it could. I'm not going to say it's it's always 30. It could be more. It could be less. It just depends on what type of loan package do we receive. Does another appraisal need to get done? Um, is the appraisal acceptable? Did the sponsor provide all the finances? Is the sponsor ready to move forward? If they've got it under contract, is it ready to go? Do they need to have an extension? Do they need to go back? We tend to get a lot of deals that either someone else can't do. They've been around for a couple of months. So it isn't like a residential transaction or just, I want to buy this house. Here's my bank statements, my income. It's, hey, I've been trying to shop this for 3 months. We've gotten halfway down the road with two other lenders and then the deal failed. So, excuse me, it can go quickly, but it depends on your sponsor.
Mm. Um, Besides of ground up construction and development, do you fund any projects that it's for example like a heavy renovation, condo conversion? We have a lot of clients that buying office building now and convert them into living space or condos and things like that. Is that something that in your space?
Yes, we do. So we finished a project up in Tennessee recently where it was 100 and some odd apartments that were not in great shape. Um, and they got funding, they're in the middle of the process of turning those, all into condos. So yes,
Perfect, perfect. So that opens up a lot of doors for us. Looks like that is a trend in many cities. We see a lot of people from cities that purchasing office buildings like this to convert them into a living space. Okay, guys, very good. Well, thank you so much, Tom, for your insight.
Hello.
Any last minute? Raymond, yes, go ahead, Raymond.
Yeah, I still have a question. Okay, I
Okay.
have a client who have like a 100-unit condominium development, but they probably like 2/3 complete, and right now they run out of money and they cannot get the regular construction loan anymore. Do you do? I mean, do you like have that kind of joint venture or any kind of partnership to like working with the developer and complete the project?
yes, that's exactly what we do.
Okay, great. Yeah.
So if you want to get, everything over to Alan and put together a package and things of that nature, that's how we receive, packages from Alan's group. And he can work with you on that. And then we'll go through to tell you, okay, this is what we need or this is what we can do.
You can like make just a loan only, or have to be a joint venture,
So
or
it
you
can
open to
it can be
or both.
it can be both. So for example, I'm going to use round numbers. Let's say it's 100 units and, just to make the numbers easy, let's say it's 100 units and it's $500,000 a unit. Okay. So the out sales will be $50 million. Okay. And you have $20 million on a construction escrow note and you need another $5 million. Okay. And let's say the $20 million note needs to be paid off. And so we're going to give you the other five. So let's say we lend 25, the 5 million, completed. Okay. So you've got a loan of 25 million. Here's the other five to construct. And then depending on what, if you're just trying to get, and this is where we get into the weeds of how long until you can start selling those, because you said it's condos. So how long does the note need to be? Is it 6 months, 12 months, 18 months? But as long as the numbers work, we're not trying to get in as a JV. But if it's one of those, you got $20 million note, you need another $5 million or $10 million or whatever it might be, and no one's going to give it to you. And that construction note for $20 million, is due. If you can't pay it off or refi it or get a bridge, you're going to lose $20 million worth of loan on a $100 million out sale condo development, we may go into the JV if there's money to be made there. It's a business, so being transparent, if it's one of those, oh, you don't want to do a JV with us, well, good luck. I hope you can find the other $5 or $10 million that you need. So we try to be really transparent with clients, and we ask them to be transparent with us because it's a small world, I'll say, in this type of lending where we see deals, people come to us as a broker and we say, we saw that deal 8 months ago. And we said, so it is not a mass world like renovation lending where, there's 100 different places you could go or broker it through. There isn't that many like this. So it's almost like we see each other's deals. So fun. But we don't have to do a JV. I'm usually aren't going to want to because we're not going to put our name or our capital in it if we don't have to.
Right.
Got it. Thank you.
Yeah. Well, that is very true because whatever Tom said is absolutely correct because we do see a lot of deals that coming to our table and quite frankly, a lot of lender out there already seen it. So that's one thing that we always do when a deal comes on is that we always ask them, have you been shopping around? What is the challenge for you not able to get a loan? Why are you coming to us? How many lenders do you already spoke to, especially for construction deal like this? Um, uh, you know, when you see deal when you see enough deals, you kind of realize that hey, is this deal doable or not? And that is why working with a company like us is very important for our client. Because again, many of us have the experience, like Tom, myself, or George's or Geo, that we have the experience to review the deal and can tell you very quickly, uh, can this deal be done or not? And of course, and another thing is that a lot of you sometimes got frustrated about, hey, why can you not funding this deal? Just like Tom said, it's not just about the LTV. It's not just about how good that particular deal is. It's also about the principle. Can the client have the ability to finish the project? What is the exit strategy? Especially in construction, we always ask, are they building it for themselves to rent out? Are they building it for them to rent it out, or what is the exit? So when we evaluate deals, we always not just looking at the deal itself, but we also look into the future and look into how can the lender or the client can get out of that deal. So again, so that's what we do in the back end, right? So again, well, good information. I hope you guys can understand a little bit more on this side of the business. Yes, we many of us are very familiarized with the DSCR type of loan, 1 to 4 unit investment property, Airbnb, that type of deal. But once you come into constructions like this, it's a totally different world. You do need expert like Tom to guide us through. I mean, even for us, many deals that come through us, I mean, George, myself, we are just have enough knowledge. So when we get a deal like this, many times we will talk to lender like Tom to discuss this deal together. And so be sure that when you submit a deal to us, you're not just sending it into a thin air. We do actually receive your deal and we do work on your deal, not only just behind the scene within the office, but we also look for experts help like Tom, their guidance, and that's what we do all day long in the back end. And I see George is online. George, would you like to say a few words about what you guys do? Because George and Becky are the one that in the back end that they look at deals all day long and analyze it and so on and so forth, and talking to different lenders. So George, would you like to share a few words?
Yeah, well, I actually had a question for Tom. This is related to the joint venture structure. Do you ever partner with landowners who may have owned the property for, say, 10 years or so, a lot of equity, a lot of potential, but just don't have the wherewithal to develop? Would you ever consider those situations?
Yeah, we would love to do that. And like I said initially, that is the sort of low-hanging fruit that's hard to find, but that's the deal. That's the dream deal where, you know, you find somebody that might be their family land for 20, 30, 50 years and they don't know what they have. And, you know, we're happy to do that. And so if you bring someone in, and they own this piece of land, but it's just zoned for R1, one home on it. But yeah, I mean, that's where we say the vultures circle. That's where the developers circle and they try to take advantage of, mom and pop people that have no idea what they're sitting on. So, we got to sleep at night. That's not who we are. So if you find someone like that, we can have the conversation. But yeah, we will do that.
Great.
And everybody can win in a deal like that. We try to be everybody's win-win. We're not trying to rake anybody over the coals. Um, we like helping. If we want to do a bridge or a workout, we're genuinely trying to do something to aid the person in the deal. And that's just a character thing for us. Because everybody I'm sure on this call has found themselves in good times or hard times, and we're not going to be the people that are going to take advantage of somebody that's down on their luck, that's got their whole life savings in the deal and like, well, we can get it for 50 cents on the dollar.
Right.
Good luck. So that's not how we do business. Love to talk about partnerships on any of that stuff.
Great.
Excellent. Thanks.
Sure. Thanks for the question. And to encourage you, the deals are out there. It's just people don't look for them because they think that, like I said, you have to be a builder developer. And so where do you go? Driving around when you see, I still to this day, I see a builder sign or I see a land sign. I call and I say, hey, realtor, who owns this? How long have they owned it? What's it on sale for? How many acres? What's it on? Just have the conversations just for the sake of polishing your sales skills. And if you have questions after you've had these conversations, reach out to Alan. We'll get connected. And I'm happy to jump on a call with you with the person. It takes 5 minutes, but it could turn into a $50,000, $152 million paycheck.
Yep.
That's how some of these deals get done. Oh, I didn't know so and so. Oh, they're selling this 50-acre, 100-acre parcel.
Yep.
I didn't know, and now I turned it into a land development, sold it to D.R. Horton or Lennar or Ryan.
Yep.
It really is that simple at times when somebody owns a land. Go to the different in your jurisdiction or wherever you live. Go to the different builder conferences. Talk to developers. So like I said, a developer is just a fancy word of saying somebody that has a piece of land they're trying to make a bunch of money on and sell it to an actual home builder. That can be you tomorrow if you go out and find somebody. And like I said, the developer a lot of times doesn't have 10, $15 million in cash, so they're trying to get loans and they get halfway through and they go, uh-oh, I need more money. And that's where we come in. So go and have the conversations with the developers and say this. I always try to give one takeaway. Go in and say, hey, do you develop land? Do you sell to builders? We have funding sources at pre and post entitlement. Just go say that. Oh, really? That's what you're going to hear because banks don't want to lend in that space now. 20 years ago they did, and they all backed out. So all the big banks, all they do is they lend typically 15, 20, $30 million lines of credit to the mid-size and the big home builders. They don't want to deal with a small developer. But those small developers, you'll find out, could be sitting on a gold mine with just one deal.
Yep. Absolutely. Elvis?
Did I hear right that with when we find these people with lands, are you looking for someone who already has a development in mind, or do you consult the property and maybe even design a proposal for them? Things like is that what I heard, or did I hear that wrong?
We do not. So I'll give a real world example. Let's say you said you're in Michigan, Elvis.
Yeah.
So there are parts of Michigan I know of where there's a lot of land development or construction going on. And because they're still affordable, if that's the right term, and still affordable homes in Michigan. So if you find land and you talk to somebody, they say, oh, I own 10, 20, 30 acres. Well, if you get that under contract, you can then do the studies and do the due diligence to connect with developers locally. But you want to get that, and this is my tip for you so you don't get screwed out of millions of tens of thousands of dollars, is if you find that piece of land, it's on 123 East Avenue, and then you go to a developer, and as soon as they ask you where's the address, if you don't have that thing under contract, good luck. Because then they're going to reach out to the owner and say, I'll give you $500,000 million. Let's get it under contract. Here's a contract, because they know all the pertinent information to turn that thing into cash. So if you have the ability to find a piece of land and you start having those initial conversations, you can get a contract written up, and it's very simple to do, where effectively it's like, hey, I want to get it under contract. I want to do a feasibility study for 90 days, and then I can get out after 90 days if I do a study. And that's where basically you have a piece of land under contract to close that you can get out. It's like a home inspection. I can get out if I don't like, what the home inspector tells me on a residential property. But that's when then you can start having conversations with people to say, hey, I've got this piece of land under contract. You don't tell them the price. Is this something, you're interested in as a developer? But you have to lock it up under contract, or the developers, that's what they do. They look for pieces of land they can take and
Okay,
they'll take
so
it from
so
you.
you don't already have developers under your umbrella. We we would try to find the land and then uh, uh, merge with a developer, then come to you, right?
Well, so we do have developers all over the country that we work with.
Right.
So if you find the land and you say, "Hey, I've got this piece of land," you know, we can reach out to developers locally. That's what we did in Tennessee on a deal that someone came to us. We went to a developer and said, "Hey, this is a deal we're looking at entertaining. Is it really worth $14 million?" And he
Right.
said,
So in
"It
other
is."
words, if I have friends that don't have the idea for what their land is just sitting there, but they don't have the vision to turn that land into something, and they don't know, and so they need to be consulted on what would work on their land. You're saying that you do that, or that you have the
We
developers to do that?
we have the developer. So that's
Okay.
where,
Okay.
just being
Okay.
transparent is nobody works for free. So if you
Right.
want someone to do almost a feasibility study or
That's
to do
okay.
the work,
That's what the
you know,
feasibility is. Okay.
and that's where you've got it under contract. Now you need to know what can you build. That's where you're going to need to spend the money to do that. So,
Okay.
but I mean, honestly, the hardest part is just finding the land for sale that people want to develop. That's the first stage of the process is everybody's just got to find the land.
Right.
And it's harder than you think, but when you do find it, that someone's willing to sell it, and that's something, and again, if you find the parcel of land that's somewhere that you want to sell, reach out because that is the hardest process.
And then me, if I work with a developer, that's coming out, that would be something coming out of my pocket.
Not necessarily that,
Okay.
but that's where you're looking at the joint venture thing, where let's say you have 20, 30 acres or 10 acres and you can build, 2 rows of town, 10 rows of townhomes.
Hmm.
The developer's going to say, okay, well, you want me to help you go through the process to get entitlements to get it to be shovel ready. That costs money.
Hmm.
You know, you have it under contract. This is going to cost $1 million to get it there. It's going to be worth 10 when it's done. They might say, I'll put in, the $1 million, but you're getting 20%.
Okay. Got it.
So, but having the land is the most powerful thing, having it locked up.
Yeah. Okay, great. Well, thank you so much for this insight on the development side of it. So thank you so much, Tom.
Sure. Thanks,
And I would
Alan.
love to have you to come online the other another time. So, ladies and gentlemen, so this is what Sequoia platform is all about. Hopefully, every Wednesday night you learn something new. So next Wednesday we will continue switch gear back to the wellness program, and we're going to share with you some case study how we get some of those companies that sign up on board with us. Okay. So until then, you know where to find us. We are on Facebook, we are on YouTube, we are on Instagram, we are on WhatsApp. We are very transparent. If you need us, feel free to text us, email us, and we will love to do some deals together with you. So, well, thank you so much, Tom. Thank you, everyone, and I see you next Wednesday night. Good night.
Thank you, Tom.
Thanks, Gio.